apologies. I'm going to go through that again and just be really quick around what I was trading on April 7th. Okay, market makers I'm going to do a quick fire run. Market makers were exposed on the upside. The reason I took calls or was interested in getting calls because I knew that we were going to read liquidity below before going higher. It could happen anytime. It could happen like in the first 20 minutes, first half an hour, first 4 hours, who knows, right? But the way that I read these gamma exposure charts is like wherever you're starting from, you need to engineer liquidity to go higher or lower, right? So in this case, because we have gravitational pull towards 6,600, the market makers don't have enough liquidity to get there right away, right? They can't just go from 560 to 6,600 in like 20 seconds or 20 minutes or whatever. It's rare that happens. It could happen. I'm not saying it's impossible, but it's not like it's not probable, right? And trading is a game of probabilities. So what happens? They engineer liquidity, and how to do that? They come up to a strike which has liquidity, then they come to another strike which has liquidity, and then they kind of accumulate between these two zones, and then all of a sudden you get an impulse move up towards that. And when I look at the chart, we get the exact same thesis playing out. So on the 7th, we open at 65.60. They go up a little bit, we reject, come back down towards 550, right? We see that clearly. Coincidentally, that's a displacement zone. So these dotted blue lines are displacement zones. We held that liquidity, ended up getting calls towards the higher strikes, and then we ended up rating 6,600 and then going in the money there. And so what I was doing that day was I got the calls right at open. They were red all day, and then all of a sudden they were up like 10x by the end of the day, right? No one held that, but I did. I got the 490s at 10:30 because I saw the rejection happening here. So 10:30 candle hits, we see the rejection. My target is from this displacement zone, the 50% here from this one, to the 50% of this one, and maybe the 50% of the one below that. And so all I was doing there was saying, hey, I want to get the 490 strike because it's close to this area of the displacement, and it was affordable at that point in time. So turn $440 into $840 there, or whatever that was. And then I got more calls. I was like, okay, well, because the dealers are exposed on the upside, it makes more sense to get the 6,600 or 6,620 calls. And these ones went crazy. They went kind of bananas. I wasn't expecting them to go as hard as they did, but they went like 600, 700%, whatever. And I was saying the whole time, I was like, hey, if we flip this imbalance, you're likely to go up towards a higher strike at 66.17. That's that next dotted blue line, right? And so if you flip this layer of liquidity or this little displacement area at 590, you go from there to the next one really quickly. And then if you flip that, you go from there to the one above that really quickly. If you flip here, you go to the one above that really quickly, right? And that's the exact same thesis that played out, right? So if I just see the last like half an hour, rated liquidity, held that, went up here, held that, went up here, held that, went up there, held that, held that, held that, rejected right there, right? So great. The thesis for that day played out exactly the way that I thought. Yes, I was early on those calls, but you never know. It could happen within the first hour, first 2 hours. It could happen by the end of the day. Who knows, right? And so the George Gamma exposure tool we built out helped me turn that one day $1,000 into 14 grand. That's insane. I didn't think I could do that in one day, but here we are. And you saw me do this on Monday. I had $877. I'll actually show you where I had it. That end of day play on Monday, right? You see this Monday, April 6th, helped me get to $877 instead of just being out that 1K that I had. So the next day, all I did was just buy as many contracts as I could afford, scalp as much as I could, and then held the 6,600 and 6,621s as much as I could. And those ended up going bonkers, right? And you see this here on the screenshot. Like, yes, one of the puts expired worthless, the runner expired worthless, but the other ones paid for that way more, right? So it turned $1,000 into 14 grand that one day. So that was 4/7, right? That's what I did. But the reason I was holding those calls all day, just so people know and understand, is because the dealers were exposed on the upside. Literally all day, there was no movement, right? And I just drew it for you. You saw me draw it for you as cleanly as I could. The way that I read these charts is like, you don't have enough liquidity to get up here. And to get up there, you need to engineer liquidity somehow. What happens? You go start here. This is where the market opened at. You go up here, raid that liquidity, come back down, raid this liquidity, consolidate a little bit. And then when you have an event that sends you up or down, that's when you say, okay, everything is great. Everything is going to happen in the way that I expect it. And we're likely going to go towards a center of gravity with the highest pull. In this case, that was 6,600 that day. So that's the reason I took those in the first place. And I know SPX is hard because you can have a 30% stop loss, 40% stop loss. I don't do stop losses, and I don't think you should do them either, because it's hard to tell where the market's going to end up and at what given point in time, right? And when you have dealers exposed with that kind of volume towards the upside, I would be hesitant to cut my calls, knowing that there's a strong chance by the end of the day we're going to get an impulse up, and maybe I turn my $1,000 into $400 or $1,000 or whatever it is, right? And so this kind of worked out really beautifully, at least for that one day where we ended up making a lot of money. So That's what happened on April 7th. Let's go through April 8th. What did I do? April 8th rolls around. I said, I ended up taking some on my main account with this huge gap up, right? And so what happens here is that 4,700 calls expired in the money. They were actually up really profitable, but whatever. They went from $400 to $8,000. That's insane. It's a once in a blue moon type of thing at that point in time. And I think here I was taking 6820 Cs, but the reason I was taking them was because of the dealer exposure towards the upside. And then I took some puts. Let's just make sure that this is what I said is actually true. I said not really liking the volume. Oh yeah, because we had this huge gap up and there's no volume that day. So I took the 6,700 Ps and then the 6,800 Cs if you can reclaim 6,770, right? And so if I look at the chart here, I took those puts right at 1044. So what happened at 1044? Let's go look. 10 a.m. rejects 1044 around here. I'd say like I want to get some puts. When I saw that rejection happening, I was like, this is the target here below. We never got there. So 6,700 maybe would have worked out if we didn't, if we kept closing below that, but we didn't. We had that displacement. The calls were kind of safe. And then we ended up going here, closing above that, didn't get up to there, and then rejecting from that whole day. So this was like an accumulation day. And looking back at it, like it was just straight up chop, right? I'm surprised I actually even played that day because there was not much movement until the day after. So I'm glad that this day worked out. Not the biggest moves, but still, you had exposure at 6,800 and then you had exposure at 6,750. 6,750 ended up becoming good support. And then 6,800, we never got to that day at least. So if I was to draw the strike ladder or the diagram around like how I read this, you have strong gravitational pull at 6,800, right? Again, not enough liquidity to get there. So what do you have to do? You have to engineer it somehow. You start here, you raise liquidity there, come back down, get up there, and maybe reject and come back down here, and then kind of go up towards that area. 6,800 was the draw. We didn't get it that day. We got it the day after, right? But that's how I was reading that chart. So that's the reason I took those 6,800 calls. And I said the reason I'm holding this is because the upside is still massively lit compared to the downside. But I didn't like the price action or the movement there. That's why I got the split. So that one day, 6820 Cs, 12%, 50%, 100%. And I just waited till the end of the day, saw some volume pick up. And then I got some puts that ended up becoming green. And then I got some calls at the end of the day, I think that ended up going green. So for April 8th, which was Wednesday, not the biggest moves, but 12, 50, 100, 60, 25, and 45, 100% winning rate that day as well. And then we did some lottos at the end of the day. So if I look at the end of the day for the 8th, I think I got these lottos on the voice call with everyone here. I literally said like, hey, we're not closing below this. We've held this layer of imbalances or this layer of liquidity. You'd like to go tag the higher ones. That's why I got the 66.75, 67.75, 770s, and 780s, because 80 was a draw for me. Like I knew it was going to likely expire in the money. If not, then at least I was covered with the 75 and 770s. So great, made some money there. Turned 14 grand from my account into, because I basically full ported into like 22K at that point in time. Solid. And then for the day after, so on the Wednesday, I was saying the day after, upside is massively lit. 6,800 was lit up, and then 6,850 was lit up, and then 6,900 was lit up. I knew we were not going to get to 6,900, but it is what it is. And again, what do you have to do? If you have gravitational pull here, you have gravitational pull here, you need market makers to engineer liquidity somehow, right? That's just how they work. They're going to raise liquidities one way or another before they decide to go up or lower, right? So the way that I was reading this is like you're likely going to open up around here, raise some liquidity, come back here. Maybe this is now your support zone. Come up here, maybe reject, and then come back down, and then kind of decide to go up or not. And so let's see how that played out. Let's see what happened on the 9th, I believe. Yes, Thursday the 9th. Market opens here, right around 6,800, 6,878 was the opening. And what happens? This is now your rejection spot. So this is actually a bit lower. I have to like lower it a little bit. And then you come back down. This acts as support, 6780, right? 6780 is the support, or this area is support. And then you decide to go higher towards this gravitational pull at 6800. So what happens? We got a nice impulse up. And then this was the 6850 was a draw. I don't think we actually got to 6850 that day. But that's really where market makers were positioned. And so I was saying for 4.9, most of this data comes out at pre-market. I was trying to do as very little as possible, but ended up holding the 6800 Cs, which I'm dead sure a lot of you got stopped out of because they were like red for the whole day until like 11 a.m. or whatever it was, or 11 p.m. or whatever it was. And so I did a straddle. Unfortunately, I had to do a straddle that day because I didn't know which way we were going to go. So I took the 6,800 calls right at open. I had 3 of them. I had hit $100 each. And then I was like, I'm going to sell 2 out of 3 at 800 and I held 1 free runner. And I did the 67.40 puts because if we reject here, you're likely to come back down towards like this area, right? And if you reject here, you're going to come back down towards an area below. So 68.40 was, or 67.40 rather, was a good risk and reward for how I was looking at it at least. And I was saying, hey, if we flip one of these displacement zones, we're going to go higher. And that ended up happening like at the end of the day, like after 11:30 basically. So yes, I made some money on the puts and it wasn't big. I was like 15, 20%. Oh yeah, here. I just said like I'm out most of these puts and I have 2 left. If it goes to zero, it goes to zero. But if we get here and if we flip this imbalance, 67.80 is the target, right? That's why I got other calls at the end of the day. So I said, I think at this point in time, I'm trying to get filled at the 67.75 because 67.80 is the target. And I got filled on these. I got like 3 or 4 contracts and then they ended up going ham. I wasn't expecting it, to be honest. And it ended up becoming green on the 6,800 as well. And these went from like $700 per contract, 700 times 7, what is that? Like $5,000 per contract. So kind of worked out for the most part. But I know no one held that 6,800 calls, even though I said the upside exposed, right? So like here you saw the screenshot of like the ladder. And for even the day before, there was a lot of exposure at the 6,800 strike. And the day of, there was a lot of exposure at the 6,800 strike. So you should have had a lot of confidence in that play, right? You could have held it all day or just found a better entry. But I'm pretty sure I said that's a main play for the 6,800 calls. And I just held them all day. I ended up working out. They, I think, peaked at like 180% or something like that, or expired in the money. They were deep in the money by the end of the day. But again, one of those 100% win rate plays or days, 1600C, 180%, 75s, which I sold at 700. And I got these instead. And those also went 700. Made some money on puts, made some money on puts, made some money on puts, made some money on end of the day calls. And then the last 10 minutes, I was trying to get the 6825 because I thought that we were going to end up closing this layer of liquidity right here at 6828. We never got there. It expired worthless, but still it peaked at 130% in zero. So like 88% win rate that day. It took 9 trades. Lost one of them, even though that was still profitable. Just did not expire in the money as I thought. But the other ones kind of worked out beautifully. So that's the reason I was holding those 6,800 calls that whole day. And same thing for the day before. I was holding those 6,600 calls all day because the dealer exposure there was massive. You have $16 million worth of exposure. And that doesn't mean it's $16 million worth of shares. It's 16 million contract that they're buying, which is huge. And I think that net value of this data is probably like $4 billion or $40 billion or something like that. I can't remember exactly what the number is. But it is what it is. And I think at one point in time, I had like 11 contracts for these 6825 or 13 contracts, or 100 contracts rather, for the 6820Cs. I had 13 of them at the end of the day. They were like $11,000, but ended up going to only 2K instead of 11K. It is what it is, but that's the reason I chose that. And so today, this coming into Friday, this is what I posted yesterday. I was like, we have a lot of exposure below. So the way that I read this chart, again, you should see this clearly by now. You can't just go to this gravitational target right away. You have to find a way to engineer liquidity to get there, right? So you open here, you go up here, rates and liquidity above, and then you come back down, rates and liquidity here, and then decide to go in this area around here, right? And so just knowing, I mean, I know what happened today, but if I didn't, like this is how I was going to read the chart. You come up here, that's why I took those calls in the morning, reject, come back down. This is your area of gravitational pull. And then you're likely going to end up around 68.10 by the end of the day. That's exactly where we ended up, right? Because $5 million worth of shares or 5 million contracts are greater than 4 million above, right? And so this morning, I took those calls. They ended up becoming profitable. Yes, the hold was tough, don't get me wrong. But they were green by 40, 50%, I think, at one point in time. And then, yeah, 50% here. We got 68.50. These are the ones from the morning. I didn't think I averaged into them once. And then I took the 6,800 puts, which ended up peaking at 40%. Not the best day, not the cleanest PA, but it is what it is. Still profitable on the day. And then ended up doing those lottos at the end of the day that expired in the money. So one dead contract, not the best win rate, but took 1, 2, 3, 4 plays. Each of them relatively profitable, not the most 700, 600% plays. And then the end of the day went up 210% there. So that's the reason why I chose to hold when I hold them and why I hold them. When you have deal exposure that is like increasingly bigger and bigger at one specific strike, you should take notice of that. So if I look at the deal exposure right now, If I was to read this, let's just make this bigger because I want to make sure that people understand how to read this. Make this height, I don't know, 40 BH. And then make sure that this is now coming back inside. Yeah. Just make this fucking... I might have to set the parent here as well. Maybe it won't let me do it because of the overflow properties that I have. There we go. Okay, the way that I read this chart for Monday, and I don't know if this is what's going to happen, but maybe. Let's go zoom into this and make this bigger so you can see it. Maybe what happens on Monday is because we have gravitational pull here, we have some gravitational pull here, we have some gravitational pull here, they're going to raise liquidity. So they're likely going to come back down here first, come back higher, reject maybe, come back lower, come into this area, and then decide to go up into 68.50. If we reject here, they come back down, come back to this area, and then from there decide to go up higher, right? So that's how I read this chart. So the Monday exposure for the dealers here is starting off a bit negative. So maybe we do a gap down, or maybe they, we can scalp some puts on Monday, and then they decide to go up, tag this area, come back down, tag this area, and then go up towards 68.50. If we can get 6 world peace, maybe we go to 6,900. I don't know. But that's how I'm reading this chart right now for Monday exposure. It's like you have gravitational pull below first. That's stronger than the ones above. You raise liquidity here. Then you decide to go up. You probably reject here, come back down towards this gravitational pull, and then go towards this one. And then if you close above this, you go towards that one, right? So this is how I read this dealer exposure. So on Monday, if I were to get calls, I would probably get the 68.50 strikes, rat it open, and just see what happens throughout the day. Let's see if the downside is exposed. I don't think it is. Prince is asking a good question around downside exposure. There's nothing there. I mean, it's not nothing, but it's not as big as you want it to be, I think. Another case that I can make there towards the downside is maybe we do something like this, where you have this gravitational pull. Maybe what happens is we start here, come back here, and then kind of go down throughout the day towards this area, and that becomes your support, and then you kind of go up towards that area. So that's another way of looking at this, is maybe this is now your wall. Maybe we don't get above 6,800 on Monday, and they raise liquidity higher before they go lower. So that's another option, or another way of looking at this chart, is maybe we start here, come back down, they do some displacement, they come up here, come back down, consolidate, come up, and then kind of come back down. So maybe that's how it goes. I have no idea. But we can make the case on both sides, right? The only thing that makes me optimistic for Monday is that we have much higher strikes being exposed than lower. So I think 6,800 is your floor. This is where I don't think they're going to let it go below. And then above here is where the target is for the end of the day. So maybe that's how it works. Maybe it's not. I have no clue what Monday holds, but this is how at least the dealers are positioned going into Monday. That's how I'm looking at it. So it gives me confidence right now, at least if I was to get some calls on Monday, especially at the 6,800 area, that knowing that there's more exposure up here, and up here compared to down here collectively, that I'd be comfortable holding those calls, even if they're red by like 50, 60%, whatever that number is, right? If you want to hedge them with a put, the best strike for that is probably going to be 67.75 or maybe 67.50, because you have enough exposure there towards the downside. But personally, I don't read the chart the way that I think Prince is describing. I read it more so as this is where you want to get to by the end of the day on Monday, and they'll probably kind of do something like this before they go higher. So that's how I'm reading it personally. I could be wrong. I have no idea. We'll see what Monday holds, but that's how I see it. So coming back to this concept of when to hold and when not to hold. When I'm telling you that, hey, we're going to flip displacements, or if we flip this area, we're going to go to the higher one, like believe it. Believe that there's something that's going to get us there, especially if you have conviction that the dealers here are looking at upside. I don't know why there's so much volume at 7,000. No clue. It came in like near the end of the day today, but you have a lot more dealer exposure at 7,000. Maybe we get there at the end of next week. I have no clue. But when you have dealers telling you that they have exposure above, and this is my mistake for today. Like I thought we were going to go higher first. We didn't go as high as I wanted to, but 6,800 was really where you're going to be supported, right? And you can kind of see that here. Like we ended up going a bit higher, coming back down, held support at 68.10 because that's an area that let it close below that. You're likely to go up above that, right? So when you have dealers telling you that they're exposed on the upside, you should be good for calls. If you have dealers telling you that they're exposed towards the downside, you should be comfortable holding puts. And so upside fading, but I don't know, maybe there's some hope. I think I said that yesterday at 1. Let's see what happened yesterday at 1. Yesterday at 1. It should be like right here. Oh no, it's 2. At 1 o'clock, what happens? Upside fades, right? All these strikes went down. 68.25 was the spot price at that time. So right happens. What happens at 1 o'clock? We ended up rejecting, coming back down towards not necessarily 6800, but 6810 became good support at that point in time. And that's exactly where we bottomed out. And when I took those 6810Ps, I think they ended up going to 130%. Yeah, there it is. 130%, 148%. So you just got to trust that when the dealers are repositioning themselves, or when you see a huge strike above or below, that's where prices like to gravitate towards, right? And none of us have, a $400 billion portfolio. I mean, maybe someone does here. I don't know. But I don't have a $100 billion portfolio here, or that much exposure on SPX. And so I don't want to bet against the people that are deploying like $400 billion towards this, right? Like I don't want to bet against those guys. If you're taking that trade, like you're going against the market makers. And so today, actually not a lot of volume. Like yesterday was 400 bill. This is 166 today, not a lot. $500 million in total exposure. It's not much, right? But when you see these strikes come up and you see the dealer exposure at like, 40 billion or whatever the number is, you should not be betting against them. And they're willing to hold and engineer liquidity to get there, right? And that's the reason I hold these contracts for so long. And I don't know when the news is going to hit. Like no one knows, right? And so sometimes the news hits right away. It's like 10 o'clock. Okay, great. Now I'm going to pump to the strike that's lit up the most. Sometimes it takes till 3 o'clock to get there, right? No one knows when the news is going to come or when that accelerant is going to happen. But it eventually does. And, whoever held that at that point in time ended up making a crap ton of money. And yeah, don't get me wrong. The drawdown stings when it's down 46%, 65%, whatever it is. It stings. But the alternative is you miss out these 300%, 180%, 700% plays. So this is the way that SPX behaves. This is why I don't do stop losses. And I wrote a message around this. So please do read it. I think I penned it yesterday. Let's just go through that once more. There it is. Okay. This thing is hard. Don't get me wrong. You can make a lot of money on SPX, but you can lose a lot of money just as easily. And the reason I choose to hold these is because I don't know what's going to happen. I don't know what the discount is. I'm going to try a different way of doing this on Monday because when the volume's there, hopefully. But I have no idea how markets are going to move or how they're going to behave, or when the volume will hit or when the news will send us one way or another. And so I tried not to do any stop losses on SPX because I know if I'm betting with the dealers, not against them, I'm going to be right 95% of the time. And the only time I've been wrong is when opposite news for what the dealers have exposed themselves with has hit. And in that case, what happens is I'll just look at the George SPX page literally all day. It's glued to my screen. And this updates in real time. So I'll see like dealers are repositioning themselves either higher or lower. And one of the reasons I got the 6-8-15 calls, but just so people know, at the end of the day is because this went from $0 to $3 million. That's solely the reason. And this ended up becoming support. And then this increased a little bit. And I got those calls at the end of the day. And also had George telling me that this is the contract that you should get. So when you're betting with the market makers, you can choose to hold as much as you want. I mean, you do what you're comfortable with, but I don't do stop losses because I know 90% of the cases, if I'm betting with the dealers and there's no opposing news that comes out, will be kind of like in the money or at least green, then I'm happy with taking that trade off. And then I'll write main whenever I can. So I said this today, like 6850 main play ended up becoming profitable by only 50%. It is what it is. And then 6800 yesterday was the main position, which ended up becoming really profitable as well. So whenever I write main, like I'm saying this is where the dealers are likely positioned. And then from here, we can either go higher or lower, depending on how we go. I hold most of my plays. All of my plays are like this. If you want to take the win at 10, 20, 30%, take the win. But every single play that I've had, except for on Fridays are the fuckiest. Fridays, just take the win as soon as you see it. If it's 10%, 20%, 30%, whatever the number is, just take the win. Because Fridays are the lowest volume. It has the dealers with the lowest amount of repositioning and has the most amount of manipulation for market makers because they're engineering liquidity for whatever happens over the weekend, especially in this day and age. And so Monday morning, we'll kind of see the results of the engineering. I don't know which way you go. And so most of my plays are like this, where they're either 100% or zero. And like, I don't care if it goes to zero because, to be honest, the plays that go to zero are far fewer than the plays that go 400, 500, 600, 700%. And you saw that happen this week multiple times. And if you can't afford to get multiple runners, just take the win as soon as you can. If it's 10%, 20%, it is what it is. Fridays have the lowest amount of setups. It has the lowest probability setups. I'm surprised I made any money today at all. And then post 2:30 p.m., realistically 2 o'clock, but post 2:30 for sure. Everything is a lot of like volume slows down until like 3:45 basically. Nothing happens. If I go and look at 2:30 onwards, what happens? Nothing. Come into here, nothing happens. Price slows down, price slows down, price slows down. Nothing happens. 2 o'clock, nothing hits, nothing hits. Volume slows down, and we just grind into this zone, right? And so this happens every single time, every single day. So 2 o'clock onwards, 2:30 onwards, everything is lotto. Because the chance of the probabilities and the chances of them becoming profitable are pretty rare and pretty slim. If you can't afford risking or losing $500, just don't play it. This thing is hard. The best risk and reward I found personally is the $300 contracts, $400 contracts. Anything lower than that, if you're buying a lottery ticket at like $100, $200, it is exactly that. It's a lottery ticket. And it's unlikely to hit unless it's like at the end of the day, like at 3:45, 3:50 p.m. as we did it today, right? So if you can't afford to risk $500, just don't play SPX because it's just you could be down 90% the whole day, and by the end of the day, magically be up like 10x. We've seen this time and time again. And yes, you can get to 1K to 14K really quickly, but it doesn't always work that way. You could easily be out 14K, but that's just the reality. And so when I play it, I'm trying to play it with being positioned with the dealers rather than against them, and we'll see where we end up. But that's the reason I choose to hold for so long. It's because I know for the most part, if I'm betting with the dealers, I'm able to capture these big moves. And if you get stopped out of these, you get stopped out, you got to do what you're comfortable with at the end of the day. But I know if I'm betting with the dealers and against them, for the most part, I'm going to be right 90 to 95% of the time. And this has not failed me to date. And I'm surprised I have a 95% win rate right now across this whole week and 100% win rate for some of these days. And for the end of the day, lottos, I'm surprised how good our win rate is to capture like 200, 300% plays. Especially if Timmy and I are aligned, like we're able to just capture those moves really quickly. But that's how I play SPX. It's hard, I get it. If you're not comfortable playing those zero-dated options, please do not play it because this thing is wild. You can go from like $1,000 to 10 grand pretty quickly, but you can also go from $1,000 to zero just as fast. If you can't take that risk, please do not play because that's not the situation I want to find you in. Like, this is not a lottery ticket. It's supposed to be methodical. And so if you bet with the dealers, you wait for the setup, you should be profitable. But what happens often is we don't know when those dealers will action that position. It could take all day. It could happen within the first half hour. It could happen in the last 20 minutes. We literally just don't know. But when the dealers are exposed at a heavy strike at 6,600 for like that one day, you should know you should be betting with them. And they're engineering liquidity to get there, right? Whenever I see this, it's engineering liquidity. Whenever I see this, is accumulation. They're engineering liquidity to do something. You see this, engineering liquidity, right? You see this, engineering liquidity. Like, this is just what happens in every single scenario here for SPX, especially. They have the impulse, they engineer liquidity. They have the impulse, they engineer liquidity, right? And so whenever you're engineering liquidity like this, it's best to stay out as much as possible and then see what the next day brings for the dealer exposure, right? But that's why I love playing SPX, is because the upside is kind of crazy. If they do the accumulation here and the dealers are exposed towards 67.20, for example, for that one day, I'm basically going all in when I see a pattern like this. When you have accumulation, they don't let it drop below a certain imbalance or displacement area, you're likely to go tag a higher one, right? And so you can use multiple confluences from the chart, from the dealer positioning to see where we might go. And where we went today was exactly where the dealers were positioned. We went on Thursday was exactly where the dealers were positioned. We went on Tuesday was exactly where and Wednesday was exactly where the dealers were positioned. And Monday, I think, was just Chop Fest. If I look at Monday, I don't think anything happened that day. Monday, nope, just chop. It was just accumulation. Accumulated, displaced down Tuesday, and then kind of went back up. So you can play SPY, you can play QQQ, you can play XSP, which is the minis. But, do what you're comfortable with there. That's all I got. Any questions? I asked people to come up with questions that they might have for me. I don't think I saw any. Go for it. Say that again? Yeah. Yeah. Okay, so I do this visually. There's two ways of doing this. One is you can either use a calculator. So if I look at SPX to SPY calc, there's a converter that exists online. So if I do 6800 here, you'll see the speed. It should be like 675, 676, 677. There we go. Split the difference. But I kind of do this visually because you can kind of see this as well. If you just look at where I'm looking at this and looking at the chart, this is why I have SPY and SPX open literally side by side, because I'm very visual and I want to see if I'm looking at the 6800 strike, right? 6800 is down here. And if I just draw a line like visually, here, I'll take a screenshot, you can kind of see it. If I just draw a line visually across the board, like right here, 6800. Oh no, I lost it. I have to do it again. There we go. 6800 is right here. And then this kind of crosses out to me at 677 on SPY. So it's literally the same as a converter. I just like to do it visually. I don't know why, but I'm kind of an idiot that way. Oh, we're going to get some pumping action overnight, aren't we? Nice. But yeah, 6800 will translate to 677 on SPY, or you can use the converter here if you wanted to. Depending on the amount of contracts. So I'm sizing up right now on SPX. I'm doing like 10 contracts minimum, which is kind of insane. I didn't think I would get here so fast because I started with $877 on Monday. For SPY, because I'm doing this challenge with everyone, it's a 100 to 5K challenge. We've been able to turn 100 to 5K, I think 3 times so far in the span of 3 months. And I was able to turn 100 into $1,500 over a week. When I'm doing this, and you see me do this like every morning, I'm doing like 2 or 3 contracts, right? So like if I'm buying 10 on SPX, you should be comfortable buying 2 or 3 contracts at the minimum on SPY. But it also depends on your portfolio size. If you only have a $500 portfolio, like get 1 or 2, stack those gains at 10, 20, 30% before you can afford to hold them, or get runners before you can get to the runners and afford to hold them for like 100, 200%, right? What I do on my SPY account for the most part when I'm trading that is I'm buying 10 contracts. And then I'm taking my first trim at like 20%. And by 20%, I'm out like 8 or 9 contracts. And I'll have 1 runner. And so having done that over and over again for the past year, I'm able to now afford 100 contracts on SPY and take my first trim of 20 contracts at 20%, right? And it's helped me build up my own portfolio to like 6 figures because I was able to stack those gains and now can hold for like 100%, 200% or whatever the number is, right? And when you get the rare days when you can get like a 10x return, or a 5x return, I even said this, like one of these will pay exponentially more than the other one. And you saw me take the 6x1 call and then the 640 put or whatever it was. That's like one of these, yes, they're $200 each, $230 each, but one of them will outweigh the cost or the loss of the other one, right? And so all I did there was split my 2 contracts across 2 contracts or 2 strikes, and then one of them just handsomely paid for the other one, right? And so that's how I would do this, is just get the... For SPY, no, you got to stack the gains. And I say this all the time. Like even when I'm doing this $100 challenge, I'm taking the win at 30%. You see me do this all the time. I'm like, okay, I have 14% here, but I'm going to hold for 20 to 30. That's exactly what I'm doing for SPY. And the reason for that is because I'm trying to grow this $100 account into as big of an account as I can. And so now I'm starting, and I think I said this, is, hey, I'm withdrawing most of this and I'm starting with $500 now. And now I can get 5 contracts, right, for $100 each, and hold 2 of them for 100% or 0. and I'll scale out of 3 of them out of the 5 contracts at maybe 20, 30, 40%, whatever that number is, right? And that's the reason I'm doing it this way, is because now I've compounded. I've went from $100 to $500. I've 5x on the portfolio. I've withdrawn $1,500, or sorry, in this case, I've withdrawn $1,000. I'm starting with $500. This is just pure profit. I don't even care if this goes to zero. I have full confidence that I will be able to hold those runners, or even hold some of these to 100% or zero. And so this is what happened yesterday. I took some puts. This was yesterday, right? Yes. I took the calls and I got some puts. This was kind of the hedge. Didn't go anywhere. This didn't go anywhere. Took some calls. Those calls were red. I think most people got started out of them. But all of a sudden, at the end of the day, they were up like 100%, right? And so I held them all day, knowing that I've made like 15x on this $100 account. I'm able to hold and withstand the drawdown there. This is recorded, yes. So I learned on my own. I didn't watch any YouTube videos. I'm kind of a dummy, because the more I watched videos, the more I tried to like read about it. I got confused. So if I go to my indicators, and you'll see all the favorites. I've tried literally everything. I've tried everything you can think of. Visible range, alerts, swing failure, session profiles, divergences, relative strength index, price action, key levels. I don't even know what the fuck this is. Hooks, kinetic law, gamma exposure, sweeps, anchored VWAP, displacement zones. Actually, I built that one. Never mind. That one's a good one because I built it. But I've used so many of these indicators in the past trying to learn how to do this. I got confused, right? And so put yourself in my scenario. Like, I'm this novice trader that's never done this before in 2025. February hits, like you have all this volatility. You got a billion of these signals at any given point in time. I'm like, what the fuck do I do? And these are lagging signals, by the way. Like, it doesn't tell you, hey, sell right here. No, it shows up like 5 minutes later. Like, yeah, of course I should have sold there after the 5-minute bar. No shit, right? Yeah, I should have bought here after the 5-minute bar. No shit. But the reality is, like, these indicators just confuse me. I'm like, I don't know what this is. Should I be buying puts? I don't fucking know. Should I be buying calls? I don't know. I don't know how to read this. I'm just a dummy, right? And so when I tried these indicators, or I tried like looking at the, I'm not trying to bash anyone by any means, but if I go to my YouTube and look at like any of the videos that I watch, which I don't think there's too many of them, I don't think I subscribe to anyone at all. Like, there's nothing here that I watch, and like there's this John Wicks guy that I try to learn futures from. Futures, whatever. What the fuck was his name? I can't even remember. And like none of them taught me how to trade. I had to learn by myself. Like I can't even find it. I can't remember what it was called. You can do paper trading, but like I just didn't know how to trade this, because like I got confused. And I think this is a problem for a lot of you as well. You're looking at like divergences, you're looking at volume, like you're looking at a lot of different indicators and different profiles. But the reality is, like, to me, they were confusing. So when I get rid of all the noise, if I get rid of all the stuff and I leave the charts as simple as possible, right? I realized very quickly that this is the only thing that matters. Is displacements, it's where liquidity is, and nothing else. And it was out of necessity that I had to do this, because I couldn't find a way to trade any other way. So I can show you some screenshots afterwards, but I learned very quickly that if we hold, not very quickly, but it took some, like maybe within a month or two, if we hold an area of liquidity here, hold this displacement, you're likely to go up. If you're holding this area, you're likely to go to the top of that range very, very quickly, right? So what happens? Did the undercut, double tap, held, came back here, rejected, did it again, right? And then all I look at is like where are market makers forced to act or react, right? Where are retail investors forced to act or react? So if I went long on this candle, for example, if I went short here, like right here, they're gonna stop me out, right? My take profit is up here, my stop loss is down here, and so like I know I'm gonna get stopped out around here if I'm a retail trader. And if I do the opposite, if I go short, let's say like, oh, I'm shorting everything here, right? I come back here, my stop loss is typically like 0.5% or whatever, 0.1%. They stop me out if I was a retail investor, and then they went to my target, right? And so like this is how I look at this: is like where are people going to be stopped out? Where are people going to be positioned? And I can use both time frames, dealer positioning, as well as where stop losses are as a layer of confluence, right? So like I really realized maybe the hard way after losing some money that if you hold here, you like to go up here. If you hold above this, you like to go up there. And I just started drawing out levels and started drawing out displacements. And literally the only the two things that you see on my chart every single day are the SMA, which I don't even use that much, to be honest, and the volume, only to see how much activity we might be able to get. Everything else I either draw myself, so like all these lines are my drawings that I draw, or I use my own indicator, which I think everyone should have access to, so I can see the imbalances without having to draw them, right? So like what happens, you come here, you're likely to go up. You close below this, you're likely to go down, right? And this has worked out really well, and you can customize this if you wanted to whatever you want. So I learned on my own. I did not use any reading or research. It was just out of necessity, to be honest, because I have to make money. Any other questions? I'm going to build all these tools for you guys so you can see when people are selling or buying or when we're going to get pinned. Go for it. Yes. You see me do this every day where I'll post a chart for the strike ladder. So before open, what I do is like I'll take a screenshot of it and mentally absorb where dealers are positioned, right? Like, so let's say on Monday, this is what happens. And I think I drew this out already, but we'll draw it out again. And I got to run 10 minutes, unfortunately. But, you know, let's say, like, I don't know what's going to happen on Monday. It's likely that we open either at 6,800 or we're going to open at 6,850. That's one of the two scenarios. But then you have to see where there's a gravitational, I call it a gravitational pull. I don't think that's the right word for it. But you'll see that if you have a lot of dealers exposed at these two strikes, price is either going to react here or they're forced to react here and then go up here, and then they're forced to react here and then go down here, right? And so this is how fundamentally markets work. It's like you're going from one dealer that has a lot of pull to another dealer that has a lot of pull, right? And to get to any of these gravitational pulls, you have to engineer liquidity. And the way you do that is to go from here to up here to come back down. This is your basing point, and then you go up here. Or another scenario here is like you open up above, you engineer liquidity, come up here, reject, come back down. This is now where you're going to be basing to either go down or up, right? So yes, I come to the SPX page every single day. It's at georgefy.trade/SPX. And it's only for the pups and bobs. If you're on the SPX only plan, you don't actually have that access. But it is there for all the other paid members. Ginny asked a good question. When do you avoid entering or doing much? Fridays are the worst days. Just do not trade on Friday if you can. Or if you take the plays, just take the win at like 10, 20%. And the way I notice when I want to trade is I go to the SPY chart. I just look at the volume. We're literally at half the volume, and the volume only picked up at the end of the day, nothing else. Yes, I'm planning on making this for other tickers. We kind of have a version of this already for gamma exposures. If I just go to analysis, GEX, it kind of exists there already. It's just a bit harder to see. So like 679, oh, interesting. Like you kind of have the same scenario here played out, then you can kind of go back to the whole week and see how prices reacted from these different zones. But I'm going to put these for every other ticker in the world. So like I'll have one for RUT, for NVIDIA, for Tesla and others. But yeah, I'm slowly working on that. I'm just trying to perfect it on SPX first because this is the only thing that's paying my bills right now. Yes. Simple moving average. Yeah, I mean, maybe a different. Okay, so let's go through this. Let's go pull up IWM, and we'll pull up IWM here, and we'll put SPY there. Sometimes what happens is one of these ETFs or indices will lead the other, right? And it depends on volume. That's one of the reasons George stayed out today, was because he's like, there's no volume. He probably the right call. So if I go back to the chart here on SPY compare that to IWM, at 12:30 we got a nice bottom here, and then IWM led in the next 5 minutes. What happens on SPY is like they had a bit of a lag. So when we got this impulse move up and up on IWM, we didn't get that on SPY until the end of the day. So like there was a lag of like 10, 15 minutes there. So that's one reason why we track other indexes or other ETFs, is because we can understand where the leading player might be. And so with the simple moving average, the rule of thumb, at least what I use, is if you're below it, I'm using the SMA here. I think this is the 12. So what I would have a simple rule of here is like if you're below this, you're likely to short every pop. And if you're above this, you're likely to buy every dip. This is just how I understand it. I could be wrong. And so one of the other reasons I was taking those calls, like we were trying to flip the SMA, and I was like, okay, I think we're gonna make some money here on calls. So that's how I do this. Is like whenever you're below it, you're likely to go and short all the pops. If you're above it, you're likely to buy all the dips, and you can kind of see a good example of that. We were above it, came back down. Displacement happens, or this is the market maker setting up a position, and heading above this, you're basically buying all the dips. As soon as you're below the SMA, you're basically shorting all the pops. So it works out really well. If you want to use that as like a light indicator or a guide, go for it. But you have to use multiple confluences in order to understand where that might end up, right? So what I use is a combination of the SMA and also displacement areas where I want to be positioned. So I use them as targets. Like if you're rejecting here, you'd like to come back towards maybe this area. If you're rejecting here, you'd like to come back towards this area. If you're rejecting here, you'd like to come back towards this area. If you hold here, you'd like to go up here. If you hold here, you'd like to go up here. If you hold here, you'd like to go up somewhere else, right? So in confluence with the SMA, with other indexes or ETFs, you can decide what play to take and double down on it if you want to or not. Yeah, I think you're probably right. It's already leading right now. Like post-market, you see that move, right? Really? Let's see. And by the way, if you're a Bob or a Pup, you should have access to this institutional volume channel. And you can see how many shares they're buying. So 375,000 shares. Pretty good. But they're selling the Qs, they're selling SPY. Oh, yes. It's actually only for the Bobs. Yeah. I like that. One thing that Fluxum asks, and this is kind of related to this page, is like George is saying, based on the structure alone and based on where dealers are positioned, energy is taking outflows. And so what happened today was kind of cool because we saw this on the rotation page, and now saying like crude oil is taking a beating here and USO is dumping. And luckily, we got the signal from the market makers before that, that, you're going to pump by the end of the day or maybe on Monday, right? And so it's kind of nice to be able to see, at least in this day and age, with whatever's going on with Iran and Israel and the US. The reason I track USO is like whenever this is dumping, they're rotating money out of this back into like SPX or whatever, or into like technology or whatever that is, right? And so like that's what I've been noticing, and that's why I have USO open literally like all the time. Is if they're rejecting this or this is declining, you're likely to get a pump on the indices, right? And you see this happening right now. This is rejecting, this is declining. You're getting a pump on ETFs. It's cool. It's exactly what we want to see. And I built this tool, or Jamie, myself, and Easy built this tool to make sure we can track these inflows and outflows. And we're going to get a huge pump probably on Monday. So now this dealer positioning makes sense. Okay. Now I see why the 6850 has been exposed all day. is we're likely going to open up around there on Monday. Fucking hell. Sure, some calls. Usually, but they're related to like futures and silver bullets. Like you have open, you have a silver bullet from 9:55 to 10:25, and you have an algorithm that happens at around 10:25, 10:30, and then you have this other algo, then another algo. What I'm trying to do at George is to figure out when the algorithms will kind of fire. And so what I've been trying to figure out right now with this guy Nick on our SPX channel is him and I just look at where market makers are positioned and at what point in time are they positioning themselves, right? If you can figure out exactly when their institutional orders are hitting, we could be positioned right before then, right? So we knew today like 315, 312 was the area to get calls or to get puts. And what happens is around that time, we ended up dumping or doing a sweep, right? And it's like the more, I wouldn't say indicators, but the more signals we get around timing, the better it is. Sometimes, not always, that we know that they're going to be positioned around these times. And so like this is what I'm trying to build in George right now is detecting when institutional algorithms fire. And they don't fire at, a fixed time every day. But for the most part, there's one at 9:30, one at 10:30, one at 1:30, one at 2:30, and then one at 3:30 to 3:55. And then there's another one at 3:55 to 4 p.m. But throughout the day at random times, like we might have one at 3:12, we might have one at 1:10, one at like 10:05 or whatever. And I get the signals for that in George. If I show you our back end, it kind of looks like this. And so I get the details from George when institutional investors are firing their signals. There's a lot of errors here because I had some errors that I got to resolve. But let me see if I can. Oh, because the market's close too. Okay, I can't get to the other upper side. But usually I can see a signal from George, like institutions are setting up their position right now. And whenever I see that, I'm like, okay, there's something happening right now that we should pay attention to. And so whenever I get those updates, I just post them in the chat saying, hey, there's going to be an algorithmic event that's happening. And so we're seeing some dark pool shares being traded here. But yeah, usually that's what I'm doing is like I'm paying attention to like our back end as well as all these other signals that we're seeing on George and dealer exposure and whatever else. Yes, sir. I'll post a recording afterwards. If people have questions, do ask, and we might want to do this again on Monday afternoon or something like that. But enjoy the weekend, everyone. I'm sure we'll chat with each other soon. No, thanks for the time, everyone. We'll chat soon.